a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're going to talk about ETFs versus ETNs in this segment with our ETF Research Director, Nina Mishra. Now, it's been a while, but we have talked about this before.
Yes.
Why is it important to know the difference of these two instruments?
Yes, there are many reasons why investors need to understand that ETNs or exchange-traded notes are different from exchange-traded funds or ETFs.
Okay.
Now, these ETNs were in focus last week because the most popular product to bet on volatility was structured as an exchange-traded note. It was an ETN with the ticker VXX, and it expired last week. And why it expired? Because it was a note. It was not an exchange-traded fund or ETFs. ETFs don't expire.
Okay.
So that is why they were back in focus. And you recall that last year in February, these ETNs, especially volatility ETNs, were in focus because volatility exchange-traded funds were blamed for exacerbating the market sell-off.
Sure.
And as an aftermath of that event, a couple of volatility exchange-traded notes, inverse volatility products, they were shuttered by their issuers.
Oh.
They just died. Whereas the fund, the ETF that was the inverse volatility ETF, which was structured as an ETF, that survived. So that is why I think investors need to understand the differences and what are the risks associated with ETNs before they decide to invest in them. Now,
so the SEC, as I see one of your bullet points, they're considering some better labeling of these exchange-traded products?
Yes, the SEC is considering better labeling of all exchange-traded products, and including ETNs, which are often misunderstood as ETFs. So once that rule comes, hopefully it will, then probably investors will have a better idea, but they really need to understand the risks associated with ETNs before they invest.
So because they're so misunderstood, let's start with ETNs. What exactly are they?
So exchange-traded notes, or ETNs, are basically unsecured debt instruments issued by a major bank or a financial institution. And unlike exchange-traded funds or ETFs that hold the securities that comprise the index that it tracks, ETNs do not actually hold any security. The issuer just promises, they're like promissory notes or IOUs by the issuer that, okay, I will pay investors the amount that is reflected by the index's performance minus fee.
Okay. So you mentioned a little while ago risk. There are risks associated with these, like any other investment, right?
Yes, yeah. So the first one is obviously, since they are debt instruments. Being debt instruments means that they carry the credit risk of the issuer, of the issuing bank.
All right.
And if for some reason the issuing bank goes bankrupt, then investors can lose a part or all of their money that was invested in exchange-traded notes.
And that happened recently.
That happened during financial crisis in 2008, when Lehman went bankrupt. So Lehman had some exchange-traded notes, and investors that held those exchange-traded notes, they lost some money, although the actual dollar amount wasn't too much, but still investors lost their money. So that is a good lesson that investors should know the credit risk involved with these exchange-traded notes.
And 2008 is not that far back.
Yeah.
So.
And then since they are debt instruments, so they have a maturity date. It's usually 30 years, sometimes 10 years, which was the case for VXX, but that expired last week. It expired after 10 years. And even before maturity, many exchange-traded notes have the call feature. So they can be called by their issuer if they are no longer attractive to their issuer for some reason. The cost of keeping them alive is substantial. Then the issuer has an option to call those notes. That is what happened in the case of volatility ETNs that died last year, and it has happened in many other cases too. Then
ETFs, on the other hand, don't have these risks.
ETFs don't have that risk because they actually hold the securities, and so that is why they are perpetual. Even if the issuer for some reason goes bankrupt, investors will receive their money back. So there is no such risk associated with ETFs.
Okay.
And then there is price tracking risk. So usually ETNs, they trade at prices which are fairly close to their intrinsic values. But there have been many occasions where exchange-traded notes traded at significant premium to their intrinsic values. And I recall the last time we discussed these differences as a part of our educational efforts. We discussed the differences between ETFs and ETNs was about 2.5 years back or so. And at that time, some oil ETNs were trading at 40–50% premium to their underlying intrinsic value. And if for some reason investors buy an exchange-traded note when it is trading at a premium to its intrinsic value, they can lose money when that premium goes down or premium dies. They start trading close to their intrinsic values again. So that is another risk that investors need to have in mind. Then there is liquidity risk. If for some reason the issuer decides to liquidate these notes, then we can see that liquidity disappears fairly easily. The liquidity just dries up.
Yeah. So protecting your investment is a big thing.
Yes.
All right. So that brings us to the benefits associated with the ETF structure.
ETN structure.
Okay, ETN structure. So what are they?
Not too many. So the first one is they do not usually have tracking error because they do not hold any securities. ETFs, on the other hand, as I mentioned, they hold securities that comprise an index. And sometimes, supposing the index is comprised of 2,000 securities, then the ETF will not hold all those 2,000 securities. It will hold maybe, for example, 400, 500 securities based on a process called sampling. So that is why, and then the exchange-traded funds, they are rebalanced at some quarterly or half-yearly intervals, so they are not very closely tracking the index. So there can be difference between the performance of an ETF, exchange-traded fund, and the index that it tracks. Since ETNs do not hold anything, so there is no tracking error in that case. Another advantage is that ETNs, because they do not hold any security, so that is why there are some certain tax advantages in some cases in certain asset classes like commodities and MLPs. So in those asset classes, ETN structure is slightly tax advantageous compared to ETFs.
So having said all of this, can we say that the benefits of one outweigh the benefits of the other, or is that not a fair way to compare them?
In my view, risks associated with ETNs are larger than benefits associated with them. In certain asset classes, like I mentioned, particularly MLPs, there are certain tax advantages, so investors can look at MLP ETNs, but they need to understand the risk associated with ETNs. That is very important.
Like any other investment.
Yes.
All right, thank you for that. And don't forget, you can always find more ETF information in that section of our website, Zacks.com. Use the Funds tab in the top toolbar, and it'll take you right to it. And then, if you want to hear more from Nina on a variety of ETF topics, go to the podcast page of Zacks.com, and she does the ETF Spotlight podcast, and you can pick it up there. With Nina, I'm Terry Ruffalo.